My feelings about my presidential heritage are more complex these days than they used to be. But we're not here to talk about that. We're here to listen to relatively new Minnesotan, Neel Kashkari, who moved here a year and a half ago, but has Midwestern roots, Akron, Ohio, as I learned over lunch, and a varied background, which I'm sure you'll hear about a little bit more today. He is, in case you haven't been reading the newspapers or watching television, one of the freshest voices on a topic that we've heard over and over again since the financial crisis of 2008 and 2009, and that's the whole issue of what needs to be done to put financial services, financial markets, financial institutions on a footing where they can more consistently contribute to positive social outcomes than they have in the not-so-distant past. And we'll get to all of that and the ethical issues around finance, but Neel, welcome. You run the Minneapolis Federal Reserve Bank of Minneapolis, and I know you wanted to start the day by telling people here a little bit about what the Minneapolis Fed does, what its role is in the Federal Reserve System, and maybe what your ambitions for the Fed are. So welcome.
Thank you. First of all, thanks for having me, John. Thanks for inviting me, and for all of you, thanks for taking the time. I always like to start just by level setting on what the Federal Reserve is and why do we even have a Federal Reserve Bank of Minneapolis. And it actually relates to the notion and concepts of integrity and ethics, which is, if you go back in American history, our country has always hated the idea of having a central bank. We hated it because it sounded like a bunch of bankers in a dark room doing God knows what for God knows what reason. And so Alexander Hamilton actually created the nation's first central bank, and it lasted about 20 years until Congress got rid of it, said, we just don't want this. And then our country in the 1800s was hammered with financial crises, including up until 1907, the banking panic of 1907. And then Congress finally said, enough is enough. We cannot keep having these financial crises. I guess we just need to have a central bank. But they said, we still don't like those bankers in a dark room doing God knows what. So they said, we're going to do something different. We're going to create a distributed central bank. We don't want all the power concentrated in Washington, D.C. So they created the Board of Governors, which you've heard of. You've heard of Alan Greenspan or Ben Bernanke or now Janet Yellen, the chair of the board. They're based in Washington, D.C. and appointed by the President of the United States. And they created 12 independent Federal Reserve banks, including the Minneapolis Fed, that are distributed around the country. And I wasn't appointed by the President of the United States. I was appointed by a local board of directors of civic leaders here in Minnesota and around our region. And my job is to represent all of you. My job and our jobs at the Minneapolis Fed are to know our region's economy. And so when we go back to Washington, D.C. to set monetary policy for the nation, we can speak with a lot of information about what's happening here on the ground. So this, from an ethics perspective, this is the compromise Congress came up with. They said, okay, if we have to have a central bank, let's have checks and balances. And the Minneapolis Fed is meant to be part of those checks and balances.
Well, so someone asked me at our table, I don't know the answer, I presume that you do, but yesterday one of the highest ranking officials in the federal government was fired. Can you be fired? And if so, who can fire you?
Well, this is a first. I have not been asked this question before. Yes, we have a board of directors here that are responsible for appointing me and presumably unappointing me. And so hopefully it doesn't come to that.
All right. You were, I mean, it's not an exaggeration to say that you were at the center of the storm when the financial crisis hit. You put together a package of support for the financial services industry we'll talk about in a minute. But a lot's been written about the fact that, to some extent, bad behavior, unethical behavior, behavior by people who forgot what their purpose in society and in the economic system ought to be, led to the financial crisis. Do you agree with that as a cause, and to what degree do you think it was a cause of the financial crisis? And do you think anything has been done or anything has happened to address what seems to be just an ongoing historical systemic issue with unethical behavior in the financial services system?
Boy, that's a tough, complicated question. When I think about the root causes of the financial crisis, there clearly were bad actors. There clearly was fraud. There was also a nationwide delusion that home prices only go up in America, because in American history, they only went up. And you could diversify. You know, Boston might be down, but then you'd be pretty sure that New York and San Francisco would be up. Or maybe Texas was down and other markets would be up. As a nation, we had never seen the idea that the entire country's housing market would fall at the same time. And so there clearly were bad actors that were taking advantage of this delusion and this risk-free rewards, and they did bad things. And I'm frustrated that not enough bad actors, not enough people who committed fraud were prosecuted. Right? There were people who should have been prosecuted. That frustrates me. But if you look back over human history, human societies are prone to mass delusion. They repeat themselves. And it's not you and me. We're not going to make the same mistake 5 years from now. Unfortunately, it's our kids and our grandkids who make the same mistakes that we make, a slightly different iteration of the same mistake. So that's unfortunate. So what it means, though, is we have to work very hard in terms of regulation, in terms of ethics, in terms of culture, to do our best to not make the same mistakes, to reduce these chances, but also prepare for the worst. We need to prepare for the fact that despite all of those good intentions, mistakes are going to be made. We are going to fool ourselves. We are going to think next time is different, and it's going to happen again. And how do we make it less painful when it does?
Can you think back on your time either at Goldman Sachs or in the Treasury Department, where you personally, just you and your God, faced an ethical issue? And can you talk about how you responded to that and how you dealt with that?
Yeah, this was, government officials need to do whatever they can to try to earn and maintain public confidence. Ultimately, so I'm at the Fed now, all of the Fed's power is granted to us by the people through their elected representatives. And so earning and maintaining that public trust is enormously important. So when I was at Treasury and Congress passed the TARP program, which is probably the most unpopular program in American history, though it was necessary and effective, it was deeply unpopular. We created a program where we were investing in hundreds of banks all around the country. And banks were submitting applications to receive this government investment. And we had members of Congress, Republican and Democrat, and senators and governors calling, sending letters, coming in person to try to tell us, hey, invest in my district's bank. Invest. Now, they were doing their jobs representing their constituents. Honestly, my job was to ignore them. And so I couldn't ignore them by saying, I'm not going to take your call. I'm not going to take the meeting. But I also didn't want to create an environment where my staff felt pressured that this senator just came or this governor just came, and now we're going to let that person influence our judgment. We're supposed to be looking out for the taxpayers. So the way I dealt with this is we created a structure where I shielded the staff from any of this influence from elected officials. And I said, elected officials, you get to talk to me, and I'm the one who makes the final call. So if there's any influence taking place, it's right here. That was the best way I could think of to manage the situation, to shield the staff, to do the cold, hard analysis, and then know and have confidence that we're making decisions for the right reasons. You know, you can create all the rules you want, but at the end of the day, people need to do the right thing. All the rules in the world cannot protect us from people not doing the right thing. And so I said, okay, I have confidence in myself. I will do the right thing, even if that means certain members of Congress or senators or governors are unhappy, and that's the best way through. Now, I can't tell you I felt like we made all the right decisions, but it didn't project great public confidence. There were still stories about members of Congress lobbying Treasury and lots of acrimony and whatnot, but I knew in my heart we were making decisions for the right reasons.
So the story you just told was really about you, and this, I don't mean it the way it's going to sound, but personalizing an ethical response on behalf of an institution, the U.S. Treasury Department. Do you think that's what it always comes down to, is someone in a leadership position behaving or modeling ethical behavior? Do you think that's what creating an ethical culture ultimately is all about, or what it requires?
I think it does. I mean, I think the structures, I talked about the Fed and the separation of powers. So some of these structures that we have created are really important, and they created an environment that enables individuals to then do the right thing and have the influence so that the outcomes are right. Right? We're seeing this play out nationally with the separation of powers between the White House and Congress and the judiciary. So these structures do matter. But again, I think at the end of the day, it is about people. And for me, I knew that I had my boss, who was Hank Paulson, the Treasury Secretary, and his boss, who was at the time President Bush. I worked under both Presidents Bush and Obama, saying, do the right thing, what's the right thing for the country, forget politics, do the right thing. So that gave me great comfort and great cover, knowing that if critics come at me, my boss and my boss's boss are in the same camp that I am. So I think it is about people.
You do have people who speak about, various names come to mind, the bailout of the financial markets under Secretary Paulson's tenure and your own as in ethical terms, as something that was inappropriate, that allowed bad actors to avoid, I guess, more serious economic damage than they would have had everybody just been left to fail. You talk about it as doing the right thing for the country. Maybe you could parse that a little bit, and do you think, looking back on it, that putting those hundreds of billions of dollars to work in private businesses and private markets was the right thing to do for the country?
Sure. So without hesitation, absolutely yes, and I'll tell you why. We hated that we had to do it. But think of it this way. I use an analogy that big banks hate, but you're going to get the analogy, and that's why I use it. Think about a nuclear reactor. If a nuclear reactor is melting down, we will spend whatever it takes to stabilize that reactor, not because we care about the power company. Forget the power company. It's because our cities and our civilization will be destroyed if that nuclear reactor melts down. Well, if a big bank collapses and brings down the whole U.S. economy, we all suffer. It's not just the employees and the management and the shareholders of that bank. So when we were faced with this dilemma, do we allow the financial system to collapse? And if we do that, we'll be standing true to our free market principles. You take a risk, you bear the consequences of that risk. But if we're all suffering because of that, that ends up not being a very good decision. So that's why it was absolutely the right thing to do. And I feel like the members of Congress and the senators who voted for it, many of whom paid for that vote with their seats. This is our nation, this is in some cases one of our finest hours of our political system, to watch members of Congress and senators put their political careers at risk to do the right thing for the country. And so absolutely it was the right thing to do, but we never, ever, ever want to have to do that again. And that's why we need to make sure that the biggest banks are actually regulated properly so that they can't get themselves back into this soup 20 years from now or 50 years from now.
Perfect segue to my next question. So we need to ensure that the big banks are regulated properly. You've had a few things to say about what that might look like. Could you walk through what you think needs to happen to put the financial system on safer, sounder, more stable footing?
Sure. So one of the first things that I did coming to the Minneapolis Fed was work with our researchers to look at bank regulation and the issue of too big to fail. And we spent all of last year bringing the best experts in the country to Minneapolis to help us study this and to hear their ideas. And we released a plan, which is available on our website, that we call the Minneapolis Plan. basically, for the biggest banks in America, roughly the dozen or so biggest banks, they need twice the equity capital that they have today. Let me back up for a second. I bought a house a year ago. My wife and I did. And the bank that we went to made us put 20% down when we bought a house. The reason you have to put 20% down when you buy a house, that 20% is there to protect the bank in case you run into trouble. That's to protect the bank. It's not to protect you, it's to protect the bank. Well, if we make banks the biggest banks, put roughly 20% down on their investments, that 20% will protect you and me, the taxpayers, in case that bank gets into trouble. And if we do that for the biggest banks in America, we can then relax regulations on the small banks that are not systemically risky for the country, that can't bring down the financial system, to free them up so that they can lend in their communities. Now, the big banks hate this. They hate this because this will lower their stock prices. And let's be honest, what's the job of a bank CEO? It's to return good stock performance for their shareholders. That's fine. I don't criticize them for that goal. That's their job. But my job and our jobs at the Fed are to look out for the taxpayers. And our analysis, which is all publicly available, shows society will be a lot better off if we really address this too big to fail issue once and for all by making sure we can protect taxpayers when banks inevitably make mistakes in the future.
In order to get a feeling for just how big and complicated the major banks, systemically important banks, and by the way, I would ask, how many institutions would you put in the systemically important category today? Are we talking about 2 or 3, couple of dozen?
It's probably a dozen or so.
A dozen or so banks, to see how incredibly complicated those organizations are these days. You just spend a week on the board of a bank holding company. It's incredible. Do you buy into the notion that banking institutions, large financial institutions, are literally too complicated to manage these days?
You know, I'm not sure. I think that they are very complicated, and there are lots of examples of whether it's, this got a lot of attention, right? The JP Morgan London whale, they had these investments they didn't understand. That ended up being a big deal. Or more recently, the Wells Fargo account scandals. But it's not just big banks that make mistakes. I mean, let's be honest. So every time Boeing or Airbus announces a new jetliner, you can be sure it's going to be 5 years late and billions of dollars overrun. So big businesses are complicated. That's not unique to banking. The difference between Boeing, though, and a big Wall Street bank is that when Boeing makes a mistake, the shareholders are not on the hook, necessarily. When a big bank makes a mistake and the whole financial system is at risk, then all of a sudden the taxpayers have to step up. And so complexity exists in lots of businesses. It's who bears the downside risk that separates the issue.
Just recently, President Trump, very surprisingly, I think directed or indicated that he wanted his Treasury Secretary, Mnuchin, to look at the whole issue of reinstating Glass-Steagall to some extent, which is this law, Depression-era law, that said banks should not mix their traditional commercial lending and insured deposit businesses with other more higher risk businesses, investment banking and whatnot. Any thoughts on whether a 21st century Glass-Steagall makes sense in the current environment?
I'm personally not opposed. We've looked at this. I'm not opposed to separating investment banking and commercial banking, but that by itself won't address the too big to fail issue. Because in the last crisis, you had pure play investment banks, Bear Stearns, Lehman Brothers, Merrill Lynch, Morgan Stanley, Goldman Sachs, that were absolutely systemic risks. And you had some pure play, more traditional lenders like Wachovia or like Countrywide that also were systemic risks. It was not simply the combination of these two activities. And so when I look at all the different things we could do to address too big to fail, there is nothing that beats capital. There is nothing that beats you putting more money down on your house to make sure that bank gets paid off. That's what equity is in a bank, and that's where I think we need to focus our attention.
So how much more capital, Neel?
Roughly double. So they're at about 10, depending how you measure, 10 to 12% now of their assets, ballpark of risk-weighted assets, is now considered equity, some a little less among the biggest banks. If we doubled it, it got them into the 20 to 25% range. Our analysis says we would substantially address the too big to fail issue.
What about the people who say that's all fine and well? What you're really suggesting is we ought to build a levee to protect against floods that doesn't just protect against a 50-year flood, it protects against a 100-year flood. It costs money that can't be used for other economic purposes. You're just putting too much dead capital into banking institutions is going to end up hurting economic growth.
So I'm glad you asked that. This is core to the analysis we've done. You're exactly right. Safety isn't free, right? Each one of you knows that we cannot eliminate the risk of terrorism in our society. You can never make it zero. And more safety comes with more cost, right? We pay for more law enforcement officers. We pay in terms of metal detectors and lines at Minneapolis Airport. So safety isn't free. So we have to decide how much safety we want and what price we're willing to pay for that safety. So the analysis that we've done at the Minneapolis Fed says that if we double the capital requirements on the biggest banks, there is some cost in terms of slightly higher borrowing costs for those banks' customers, but not for small banks' customers, by the way, not for mid-sized banks' customers. And overall, the benefits of avoiding these crises far outweighs the costs. So you're right, it's not free, but the benefits outweigh the costs, and that needs to be what we're trying to maximize here.
Well, really what you've been suggesting is to build higher levees,
Exactly.
more flood protection in the areas that most need it, i.e. in large, systemically important, complex financial institutions, and lower them where you don't need them, i.e. at the community bank level.
That's exactly right. Great analogy.
Okay, well, let's use
I'm
another.
glad that you're on board.
All right. Well, I didn't say I'm on board, but I don't work. I don't work for a financial institution anymore. But I do need credit, so I have to be careful. By the way, Neel wrote about an article about. I think you wrote an article. You gave an interview about getting your mortgage.
Yeah.
And you said it's the darndest thing you've ever had to go through. As a presumably credit-worthy borrower running a Federal Reserve Bank, you had to jump through more hoops than should have been the case. Let's use the nuclear reactor analogy again, though, because it's been said that too big to fail, there's nothing you can do to solve too big to fail. In other words, that no matter what kind of protections you build into that nuclear reactor and how many times you test the fuel rods and, clean it and maintain it, if you ever got to a point where you were looking at a meltdown, you would have to face the choice to rescue or let fail, i.e. let melt down. So you're always going to be looking at a too big to fail possibility. Sounds like what you're trying to do is just reduce the risk that will ever happen again. Not that it won't ever happen again, but it's less likely than ever before to happen again. Is that true?
That's exactly right. Your Levee analogy is perfect. You can never protect for a million-year flood, right? So you have to decide, is it a 100-year flood, 50-year flood, or whatnot? And so we feel like cost-benefit analysis says this higher levy of doubling the capital requirements on the biggest banks is optimal for society. But you're right. You can never say never. Just like with terrorism, you can never say we've eliminated all risk of terrorism. We've done our best within reason, within appropriate costs.
Lot of talk right now in the Republican-controlled Congress about rolling back or replacing the Dodd-Frank Act. So, tens of thousands of pages of legislation, maybe thousands of pages of legislation, millions of pages of regulation, still, 30, 40% of the act yet to be implemented. Do you believe that post the crisis, the regulatory pendulum has swung too far and needs to be brought back? Or do you think this is a necessary corrective? Do you support, in other words, leaving Dodd-Frank alone, changing it, or getting it off the books?
Well, I think Dodd-Frank has done some good. So the truth is, let's give credit where it's due. The biggest banks do have more capital today than they had before the last crisis. They do have longer-term liquidity sources of funding, which is a good thing. We do stress test the biggest banks to look for downside scenarios. So progress has been made. I wouldn't want to roll that back off the biggest banks. I do want to roll back some of that net off of the little banks that are not systemically risky for the country, that are being caught up in the same regulatory net. And so it's, again, somewhat of a nuanced argument. Keep it on the biggest banks, relax it on the small banks. But again, we have not gone far enough on capitalizing the biggest banks. And if we really had that levee that you talked about built high enough, then we could relax some of the micromanagement that's going on today, because we'd have enough comfort that this levee of equity is there to protect us in case they make a mistake.
Okay, I worked for a Canadian bank. My wife is Canadian. I took out a mortgage in Canada on a home we had there, and I'm bringing this up because one of the areas that hasn't been addressed is in the whole financial reform arena is the mortgage finance system in the United States, which of course was ground zero when it came to causative effect. In Canada, there is no originate to sell model. In other words, every mortgage in Canada ends up being held on the books of the bank that originates the mortgage. As opposed to the United States, which at least going into the crisis, most of the loans were packaged to sell somewhere else and didn't stay on the bank's books. That means the effect is that in Canada there's no such thing as a 30-year fixed-rate mortgage. In the U.S. there is, because the loans are sold to people who are willing to take a fixed rate for 30 years. And yet the home ownership rates are exactly the same, Canada in the U.S. There's not even tax reform today's in the air. Is there going to be a mortgage deduction or isn't there? There isn't a mortgage interest deduction in Canada. So no 30-year loans, no mortgage interest deduction, same home ownership rate. What's the public benefit to the system we created? How do you feel about the system of mortgage finance in the U.S., and what do you think needs to happen to reform it going forward?
Well, another very, very complicated question. It's funny how things work out. So we had the Great Depression, and a bunch of regulatory bodies were created in the wake of the Great Depression to try to prevent it from happening again, including the Securities and Exchange Commission, for example. But also, Fannie Mae was created to support mortgage finance. I guarantee you the founders, the authors who created Fannie Mae in Congress, never envisioned that 80 years later, their creation would cause a systemic risk or itself be a systemic risk in 2008. So sometimes these things have unintended consequences way into the future. Right now, the big unknown is what Congress is going to decide to do with Fannie Mae and Freddie Mac, the GSEs, and the Federal Home Loan Banks, which are also funding a lot of mortgages now. And this is a political decision that Congress needs to decide. What role does the American government and do the American taxpayers want to be involved in mortgage finance? Do they want to have any involvement? A lot of involvement like they've had historically?
And right now, it's almost 100%.
And right now, or something less than that. And so there are you can design systems that work in any of those alternatives, but it really is for Congress to decide, hey, what role do we want taxpayers to play? I would personally encourage less involvement, but that's going to be a political decision.
Okay, we've got about 5 minutes left, and so let's pull it back at the end here to the whole issue of ethical behavior, which of course is really what this lunch is all about and these awards are all about, ethical behavior in the business sector. And some of your comments earlier about what you tried to do at Treasury to ensure that we were doing the right thing. Do you fall in the camp of people, this is just a personal belief or not, that ethics can be taught? That you can help somebody understand what it is to be an ethical business person, that you can help them, in fact, act out in more ethical ways? Do you believe that is taught behavior, or does it come from somewhere else?
Well, I think we're taught, we learn lots of ways. You learn through school. By the way, I sat at a table, a part of whom are ethics professors, so if I were to say you can't teach it, I think they'd be very upset.
That's all right. They can take it.
So part of it is you're taught formally through school, And part of it is you're taught by your parents, and you're taught by role models you have, and people you look up to, and people you learn from. And so I've had some great role models along the way. I mean, again, I go back to the financial crisis. I have enormous respect for my old boss, Hank Paulson, and I have enormous respect for Janet Yellen and her predecessor, Ben Bernanke. And one of the things I'm really proud of the Fed is, by and large, it's full of people who really care about their country and have a commitment to public service. And when you're surrounded by people who love their country and have a commitment to public service, it's a lot easier to do the right thing because everybody's naturally inclined to do that. So I do think you can teach it, and I do think that how we treat each other and how we teach each other and share our experiences does matter and does have influence, and we should all help each other to try to do better.
Okay, conveniently, you talked about your government experience. You also worked for Goldman Sachs, and of course I spent most of my career in the private sector. Why does it seem like the financial services industry continues to be, always has been, more ethically challenged than other business sectors of the economy? First of all, do you agree that it does? And if so, why do you think that might be the case?
The honest answer is I don't know if it actually is more, we hear about it a lot more. And so I know that. It's in the paper a lot more, probably because the dollar values that we're talking about are a lot more. We don't hear about a small manufacturing company cutting a corner here or there. But the financial system needs to do better. The financial industry needs to do better. And so, and if for no other reason that we hear about it, and it plays a very vital role in our economy. And improving the culture of Wall Street, I think we should all try, but we should also be realistic, and we have to assume the worst. This is going to probably enrage people when I say this.
Good.
But it's like
we need Twitter feeds.
I know this is going to really set them off. But are you really going to change the culture of Las Vegas? People go to Vegas because they want to gamble, and so yes, there are little brochures when you go to Vegas and saying, "Here are signs you have a gambling addiction. Call this hotline." But at the end of the day, people go to Vegas because they want to gamble. And so the solution to Wall Street ethical behavior, culture and teaching them and encouraging good behavior is all really important, and we need to do that. But we also need the belt and suspenders of a strong regulatory environment when those cultural initiatives don't get us all the way there.
Well, the headline there is going to be, Minneapolis Fed compares Wall Street culture to Las Vegas.
Yes.
I've waited 50 minutes for this moment. When David Radborn called me and asked me to do this, I jumped at the chance because I wanted to meet Neel Kashkari. He really is a fresh voice in the financial services industry generally, and has throughout his career exhibited what it means to really act out of a place of servant leadership, treating yourself as having an office. It's not an elected office, but it's an office, and you have constituencies. The people in this room and the people in the region and the people of the country, and you've exemplified the kind of behavior that this award ceremony is all about. And on behalf of all of us here today, I want to thank you for being part of this event. And I hope you'll all join me in thanking Neel for sharing his thoughts with you today. Thank you very much.
Thank you. I really appreciate it.